Welcome. Today, we are looking at joint stock companies. This is a key topic in your commerce exams for SS1. Pay close attention. Let us begin. First, let me explain the meaning of a joint stock company. A joint stock company is a business organization that has a separate legal existence from its owners. The owners are called shareholders. They own shares in the company. The company is managed by directors elected by the shareholders. The capital of the company is divided into shares. Shares are transferable. Shareholders have limited liability. They can only lose the amount they have invested in shares. The company can sue and be sued in its own name. It can own property in its own name. It can enter into contracts in its own name. The life of the company is not affected by the death or retirement of shareholders. This is called perpetual succession. Joint stock companies are the most important form of business organization for large-scale enterprises. Examples include Dangote Cement, MTN Nigeria, First Bank, and many others. Now let me explain the features of a joint stock company. A joint stock company has several distinct features. First, separate legal entity. The company is separate from its shareholders. It can own property, enter contracts, sue, and be sued in its own name. Second, limited liability. Shareholders are only liable for the amount unpaid on their shares. They cannot be asked to pay more. Their personal assets are safe. This is the most important feature. Third, perpetual succession. The company continues forever. The death, retirement, or bankruptcy of a shareholder does not affect the company. Shares can be transferred. New shareholders can join. The company goes on. Fourth, transferability of shares. Shares can be bought and sold freely. In public companies, shares are traded on the stock exchange. Shareholders can leave the company by selling their shares. Fifth, common seal. The company has a common seal. This is the official signature of the company. Documents sealed with the common seal are binding on the company. Many countries now allow companies to use a signature instead of a seal. Sixth, separation of ownership and management. Shareholders own the company. Directors manage the company. Shareholders elect directors. Directors appoint managers. This allows professional management. Seventh, registration. A company must be registered with the Corporate Affairs Commission or equivalent government body. Registration gives the company its legal existence. Eighth, share capital. The capital of the company is divided into shares. Shares are of small denominations. This allows many people to invest. Ninth, democratic management. Shareholders vote at annual general meetings. One share usually gives one vote. Major decisions require shareholder approval. Now let me explain the types of joint stock companies. Companies are classified into several types. Private limited company is one type. A private limited company is often called limited. It has the following features: minimum of 2 shareholders, maximum of 50 shareholders. Shares cannot be offered to the public. Shares are not traded on the stock exchange. Transfer of shares is restricted. Other shareholders must approve transfers. A private limited company is suitable for family businesses and small to medium enterprises. Public limited company is another type. A public limited company is often called PLC. It has the following features: minimum of 7 shareholders, no maximum. Shares can be offered to the public. Shares are listed and traded on the stock exchange. Shares are freely transferable. A public limited company is suitable for large enterprises. It can raise huge amounts of capital from the public. Companies can also be classified by liability. Company limited by shares is the most common type. Shareholders' liability is limited to the amount unpaid on their shares. Company limited by guarantee is another type. Members guarantee to pay a fixed amount if the company is wound up. This type is used for nonprofit organizations, clubs, and charities. Unlimited company is a third type. Members have unlimited liability. This type is very rare. Companies can also be classified by ownership. Holding company is a company that controls other companies. It holds more than 50% of their shares. Subsidiary company is a company controlled by a holding company. The holding company owns more than 50% of its shares. Government company is a company where the government owns at least 51% of the shares. Foreign company is a company incorporated outside Nigeria, but doing business in Nigeria. Now let me explain the Memorandum and Articles of Association. The Memorandum of Association is the constitution of the company. It defines the company's relationship with the outside world. It contains the following clauses. Name clause states the name of the company. The name of a public limited company must end with PLC. The name of a private limited company must end with limited. Registered office clause states the location of the company's registered office. Every company must have a registered address. Object clause states the activities the company can carry on. The company cannot do anything outside these objects. This is called ultra-vires. Liability clause states that shareholders' liability is limited. Capital clause states the amount of share capital the company has and how it is divided. Subscription clause states that the subscribers to the memorandum agree to take shares. The memorandum is the fundamental document. It cannot be changed easily. Changes require shareholder approval and government consent. The Articles of Association contain the internal rules of the company. They govern how the company is run. The articles cover the following: rights of different classes of shareholders, how directors are appointed and removed, powers and duties of directors, procedure for board meetings, procedure for shareholder meetings, how dividends are declared, how accounts are kept, how the common seal is used. The articles can be changed more easily than the memorandum. Companies can adopt model articles provided by the government. Many small companies use these model articles. Large companies often write their own custom articles. Now, let me explain the formation of a company. Forming a company involves several steps. First, promotion. Promoters conceive the idea of the company. They investigate the business opportunity. They arrange for initial capital. They prepare the memorandum and articles. Second, registration. The promoters submit the memorandum, articles, and other documents to the Corporate Affairs Commission. They pay the required fees. If everything is in order, the Commission issues a certificate of incorporation. This gives the company its legal existence. Third, for a public company, there is an additional step. After incorporation, the company must issue a prospectus to invite the public to buy shares. The prospectus must contain full and true information about the company. After receiving applications for shares, the company must apply for a trading certificate. Once the trading certificate is issued, the company can begin business. Now, let me explain the advantages of a joint stock company. Joint stock companies have many advantages. First, limited liability. Shareholders can only lose what they invested. Their personal assets are safe. This encourages investment. Second, large capital. Public companies can raise huge amounts of capital by selling shares to the public. This allows them to undertake large projects. Third, perpetual succession. The company continues forever. The death of a shareholder does not affect the business. This gives stability. Fourth, transferability of shares. Shareholders can easily leave by selling their shares. This gives liquidity. Fifth, professional management. Directors are often experienced professionals. They can manage the business better than owner-managers. Sixth, economies of scale. Large companies can produce goods at lower cost per unit. They can afford expensive machinery and technology. Seventh, risk spreading. Many shareholders share the risk. No single person bears the full risk. Eighth, public confidence. Companies are regulated by law. They must publish their accounts. This builds trust. Customers and suppliers prefer to deal with companies. Ninth, borrowing capacity. Companies can borrow more easily than sole proprietors or partnerships. They can issue debentures. They can get loans from banks. 10th, Tax benefits. In some countries, companies pay lower tax rates than individuals. There may also be tax deductions for certain expenses. 11th, growth potential. Companies can grow very large. They can expand into new markets. They can acquire other businesses. 12th, research and development. Large companies can afford to invest in research. They can develop new products and technologies. Now let me explain the disadvantages of a joint stock company. Joint stock companies also have several disadvantages. First, complex formation. Forming a company requires many legal formalities. It takes time and money. You need to prepare many documents. You need to register with government agencies. Second, loss of control. Shareholders own the company but do not manage it. Directors and managers run the business. They may not act in the best interest of shareholders. This is called the agency problem. Third, lack of secrecy. Companies must publish their accounts. Anyone can see their financial information. This includes competitors. Fourth, heavy regulation. Companies must follow many laws and regulations. They must hold meetings. They must file annual returns. They must have audits. This is expensive and time-consuming. Fifth, double taxation. In some countries, the company pays tax on its profits. Shareholders also pay tax on dividends. This is double taxation. Sixth, separation of ownership and control. Shareholders may not know what managers are doing. Managers may take excessive salaries. They may make bad decisions. Seventh, speculation. Shares of public companies are traded on the stock exchange. Speculators may buy and sell shares based on rumors. This can cause price volatility. Eighth, vulnerability to takeover. If another company buys more than 50% of the shares, it can take control. The original owners may lose their company. Ninth, high cost of compliance. Companies must pay for audits, filings, and legal advice. These costs can be significant. 10th, impersonal relationship. Large companies may not have personal relationships with customers. Customers may feel like just a number. A common exam question asks you to define a joint stock company and state its features. Here is a sample answer. A joint stock company is a business organization with separate legal existence from its owners. Its features include separate legal entity, limited liability, perpetual succession, transferability of shares, common seal, separation of ownership and management, registration, share capital, and democratic management. The company can sue and be sued in its own name. Shareholders have limited liability. Another exam question asks you to distinguish between a private limited company and a public limited company. Here is your answer. A private limited company has a minimum of 2 and maximum of 50 shareholders. Its shares cannot be offered to the public. Shares are not traded on the stock exchange. Transfer of shares is restricted. A public limited company has a minimum of 7 shareholders and no maximum. Its shares can be offered to the public. Shares are traded on the stock exchange. Shares are freely transferable. Public companies can raise huge capital from the public. Another exam question asks you to discuss the advantages of a joint stock company. Here is your answer. The advantages include limited liability, large capital, perpetual succession, transferability of shares, professional management, economies of scale, risk spreading, public confidence, borrowing capacity, tax benefits, growth potential, and research and development. Limited liability is the most important advantage. It encourages investment. The company continues forever, regardless of changes in ownership. Let me give you a quick summary. A joint stock company has separate legal existence. Features include limited liability, perpetual succession, transferable shares, and separation of ownership and management. Types include private and public companies. Formation involves promotion, registration, and for public companies, a prospectus and trading certificate. Advantages include limited liability, large capital, and professional management. www.ssone.com Disadvantages include complex formation, loss of control, heavy regulation, and double taxation. Keep reviewing, keep practicing. See you in the next topic.